Hey everybody, welcome to the first real estate insurance presentation that I'm doing. This is going to show you guys how rich people use life insurance policies so that they can do more deals. Now, when people hear about life insurance, they just think about the death benefit. And we're going to be uncovering so much more. How you as investors get to protect your assets, have tax benefits, and do more deals. And that's what it's all about. So life insurance is one of those vehicles that the more you know about it, the more you can do with it. So I'm glad you guys are on here. I'm glad to be able to present to you guys the ideas around life insurance and how it gets to benefit your life. Before we get started, I want to introduce my co-host for today. It is Mr. MC Lopshire. He has a podcast called The Cash Flow Ninja that's listened to in over 180 countries, and it talks all about real estate investing and financial intelligence. So MC, could you please unmute yourself and introduce yourself briefly?
Hi, everyone. I'm excited to be on this call. And yeah, as I'm saying, so I've got a show called Cash Flow Ninja where we share a lot of different cash flow strategies, utilizing a lot of different tools and a lot of different vehicles, everything from businesses, real estate, paper assets, commodities. We've even yeah, and we just talk a little bit about cash flow, and then I also have a firm called Producers Wealth. We are now conducting business in all 50 states virtually. So 5 years ago, when I started the firm doing business virtually, a lot of folks are kind of laughing at me when I first started. But now it's kind of normal, and I think it's going to be the new abnormal, not the new normal, right? But yeah, we consult virtually, and what we do is we help investors and business owners reposition capital, recapture cash flow, and structure cash flow management systems utilizing a couple of different tools, which one of the tools we're going to be talking about today, which I don't think a lot of people are familiar of how to use this tool in your overall cash flow strategy. So excited to jump in. Thanks for having me, Han.
No problem, MC. So I brought MC on here because he will be able to give us insight on how his clients have used these policies, how he has used these policies. He's just going to be my resource for telling us all cool stories, because everybody loves great stories of how people have used this to benefit their life, their family, increase their wealth, and all that kind of stuff. Now, MC used words in there that may have went in one ear and right out the other without you knowing it. So what he said was that this is going to be a way to capture wealth. What does that mean? He said it, and it was real brief. He just kind of said it. So what I want you guys to begin thinking about is that life insurance is kind of like a fancy checking account. It's just like when you get paid, you're going to put your money somewhere. You're either going to put it in a savings account, a checking account, a Roth IRA, or 401k or something, right? Your money is going to sit somewhere. I want you guys to think about life insurance as another place to sit your money. It's a wealth capture. It's capturing your wealth. It's holding your wealth. And so that's how I want you guys to picture it. I don't want you guys thinking, oh, this is all about the death benefit. So let's get into the presentation. Let's talk about it's going to be a quick one because I just want to go right back into dialogue. I don't like presentations too much. I like dialogue though. All right. So let's see. On my screen, I can see MC. MC, give me a thumbs up if you can see the slideshow. Yeah? Okay, awesome. Awesome. All right. So life insurance by me, Hone Tai. Who am I? That's me. Hone Tai, investor, lender, educator, insurance broker. Some of my philosophies, assets over hours. What does that mean? That I believe that we should acquire more assets, not necessarily more hours at work if we're trying to become more financially wealthy. Also, fire, aim, ready instead of ready, aim, fire. I think that most people get hung up where they're like ready, aim, 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 and they never fire, and that's a problem. So I say fire, and then once you're in it, once you signed your name on the line, then you get to aim, and then you'll be ready. I also believe that you all have a gift. The problem is that most of you spend too much time at work, and so you don't have time to think about what your gift is, and you don't get a chance to hone your craft, right? And you can't make your gift the level that it needs to be in order to be very valuable to the world. So I believe you all have a gift. And if you had more time to refine that gift, that you would be able to share that gift with the world and possibly get paid for it. And finally, I believe that the world is abundant. It is, think about what just happened with this pandemic. For you guys who are watching the recording, and you might be watching this 10 years from now, the year is 2020. The month is May. So this is May 20th or May 2020. We are in a pandemic, right? And what happened was the government released trillions of dollars out of nowhere, just poof, right? And what happens with the money is it goes to people. So people receive this money, but they don't just sit on money for the sake of sitting on money. They will spend it. So now the question is, how do you get more of it? Right? Think about that. How do you get the money that other people just received? The world is abundant. They will continually print more money. You just have to have a big enough bucket to catch all of it. And you also have to have a valuable enough bucket for people to want to put their money into that bucket, right? So the world is abundant. Don't think otherwise. If you guys want to email me, you can do insurance@honesloans.com. All right, so let's get into it. So what are we going to be talking about? Well, it's how the rich use life insurance and to create more wealth. So step one, we're going to view how most people view life insurance. Step two, we're going to do a bet. Okay, we're going to do a bet, and it's going to be interactive. So term insurance basics. 3, we're going to look at how to read a policy illustration. 4, we're going to get into the magic of whole life insurance, the reason why we're all on here. And then 5, how to actually apply it to your own life. So the big, bold statement, the rich do things differently. The cool part is you can too. And the rich, when they look at life insurance, they look at it a little differently than what the poor and the middle class do. It's just a slight variation. The poor and middle class, they look at life insurance like this. You die, the insurance company pays you. And that's the only way people think about life insurance usually. They're just like, okay, Hone, what's the big deal? So they don't actually think about life insurance. They think about death insurance. This is the death benefit. But what I'm talking about is the life part of life insurance, meaning what can you do with it when you are alive? All right, so the next part, let's bet. And this is term insurance. How much would you bet on my life? Or how much would you bet on your life? So the question is, how much money would you pay me to insure your life to the end of today? Meaning, if you die by today, I will pay your family $500,000, right? If I charged you $1 for that insurance, would you pay? And this is a good time to use the comment box, okay? Or you can take yourself off of mute. If somebody wants to play the game with me, let's see, who wants to play the game with me? And then take yourself off of mute. Let's play the game real quick. Anybody? Lenny. Lenny said yes. Okay, so Lenny, please take yourself off of mute and let's play this game. You off of mute yet, Lenny? Come on, Lenny.
I got you.
There you go.
You hear me?
I can hear you now. All right, Lenny, let's play a game. Let's pretend I'm the insurance company, okay?
Right.
I'm the insurance company. We're doing a bet here. So Lenny, you have a wife and a child, correct?
Right.
Okay.
Correct.
Wouldn't you love for them to have $500,000?
Yes, sir.
You would love that, right? I would love to give that to them, but you know what? We're going to have to play a game though. So I'm going to insure you. For $500,000 until the end of today. And it's going to cost you $1. Would you do it? Would you pay me $1 to insure you till the end of today? So that means you give me $1. If you die, your family gets $500,000. If you don't die, I keep the $1.
Nah.
Okay, fair enough. What about to the end of the week? You pay me $1. If you live to the end of the week, I keep the $1. If you die within a week, I give you $500,000.
I'm gonna say yes.
Okay, awesome. All right, would you pay me $2?
I'm gonna say no.
Okay. All right, $2. If you die at the end of the year, would you pay me $2 to insure your family for $500,000?
Yes.
Okay. What if I said $10?
No.
Okay. What if I said $10 for 10 years? If you died in 10
Yes.
years, I would give you your family $500,000.
I say yes.
Yes. Okay. What if it was $100?
For 10 years?
$100 for, yep, I would cover you for 10 years. If you don't die in the 10 years though, I keep $100.
I say yes.
Okay. $1,000.
I say no.
Okay. What if you paid me $1,000 for 20 years?
Yes.
Okay. How about $5,000 for 20 years, covering you for 20 years? $5,000, your family gets $500,000.
No.
All right. How about 30 years? $5,000 covers you for the next 30 years. If you die in 30 years, your family
No.
gets paid. You wouldn't pay $5,000 for that protection?
We got to work on your bucket list.
Who, me? No, I'm gonna say yes. I was saying no because I started thinking it was, because I really don't know where you're going with this exactly.
Doesn't matter. I don't want you to know. That's the thing. I don't want you to know where I'm going with this. I don't want you to.
Right.
I want you to answer genuinely, because everybody else.
Okay. Yeah. I would. To be honest, yes, I would. Right now, with the knowledge I have, yes, I would.
Right, because $5,000 is a very small price to pay to cover you for the next 30 years, right?
Yes.
Right. Okay. What about 10,000?
Yeah.
What's that?
Yes.
Yes. Okay. How about 20,000? $20,000. If anything happens to you from now until you die, right? Now until you die for 30 years. Yes or no?
Yeah.
Okay. All right. What about $50,000?
I don't know. It's getting up there now.
Okay. Okay. Fair enough. So let's say $50,000. What about if you paid $50,000, right? $50,000 for insurance, and whenever you die, your family gets $500,000. So I'm covering you for the rest of your life, death. Would you do that? You pay $50,000 now, and then you get covered for the rest of your life. Would you do that?
Yes.
All right, awesome. What about $100,000?
And you said that's got to be all up front, like today?
Let's say we can spread it over time. Let's say you can pay $10,000 for the next 5 years.
Yes.
Or whatever, right? So you can spread it over. Okay, so
yeah, double it.
Okay, so what I was actually doing, and whoever's writing on the screen, I don't know what you're writing, but thank you. Now, erase that.
Hey,
So,
that
is that you?
that helped me for a second. No, it's not me. I thought it was you. I thought you were trying to like lead me on to understand a little bit. So
if I had to guess,
whoever it was, thank you. Huh?
I think it was Damien. I'm just gonna guess. Oh, it wasn't Damien. Anyway, all right. But okay, but what I wanted you guys to see from that little illustration, right? Lenny was not prepped. He was actually just trying to figure out what the heck I was leading up to, and he couldn't figure it out. So we started off with $1 and we ended up with $100,000, right? And what he said essentially was that he was willing to pay more and more and more for a longer period of time. And by the time we got to infinite, meaning like we're covering you until death, that he was willing to go way up in how much he was willing to pay for that insurance. That is how term insurance works. So right now, term insurance, they'll cover you for a year, 2 years, 5 years. You can also fix it for 10 years, 20 years, and with some companies, even 30 years, you can fix it. But the problem, or not even the problem, how it works is every time you choose a longer duration, you're going to be charged more, right? But you're willing to pay more. You notice how I didn't say to Lenny, like, this is how much it costs. It was more so like, hey, Lenny, would you be willing to pay this kind of thing, right? So he said yes. He was willing to pay more because he saw that coverage for a longer period of time was more valuable. So the most valuable, though, is the one that covers you all the way until death. The problem with term insurance is that there's a fixed period, 10 years, 20 years, maximum 30 years. And then after that, if you don't die within those 30 years, all the money that you paid into that policy is gone. And that's kind of bad because that feels like a waste. If you got covered until you died, that would be pretty cool. The problem is the only way to do that is to get it in whole life, not term. You can't buy term for your whole entire life if it goes beyond 30 years. So there are people who talk about buy term and then invest the difference. Well, what you're missing out on is that you may not die in that term policy or that term period. And if you don't, then it was a waste of money. What I'm showing you guys is a way to have a little certainty. But before we go into that, let's look at a policy real quick. So policies, let me see. All right, here we go. Policies are very interesting. They look very confusing. So if you look at, so this was a policy written on a 38-year-old male, and I think it was at standard underwriting. What you'll see in that third column is total premium. That's how much a person pays every single year. And in this policy, it's $12,000, just to keep it nice and round, because that's $1,000 per month. Okay, $1,000 per month, $12,000. If you look at the sixth column, you'll see the cumulative premium, meaning year one, you pay $12,000, year two, you pay $24,000, year three, $36,000, $48,000, $60,000. You guys all see that, right? Give me a thumbs up. Do you guys see that? Give me a thumbs up. You guys understand that, right? Okay, so that's the premium outlay. Now, if you go 3 columns over, you'll see the net cash value. The first number is $9,471. The next one is $19,845. The next one is $31,395. Next one, $44,330. That is the cash value within your policy. That's the magic right there. That's what we're very interested in. That is your checking. That's your special checking account that I was talking about in the very first minute of this conversation. The cash value is what we care about. Now, if you go all the way to the right, there's your death benefit. Okay, so your death benefit is how much your family would get paid if you died in that year. In the beginning, it's $516,640. Then it goes to $559,366, and it grows. That's the cool part. It grows. Term policies are fixed. So you'll buy a $500,000 policy or $1 million policy or whatever it is, but that's fixed. This policy grows for the rest of your life. Now, let's look at the next page. So this is further down the line. This is after 20 years. Look at line 33, that's year 33, that you've been paying into it. So if you go to the cumulative premium outlay, we have paid into the policy $394,929 total. That's month after or year after year after year. At year 24, we reduced the payment. We reduced the payment. That's why it's like not a round number. We reduced the payment. So now, if you go over 3 more columns, you see the cash value. We're at $950,000, meaning we put in a little less than 400, and then what we have in return is a little less than $1 million. If you go to line 34, we are starting to take money out of the policy. We chose to retire. Welcome, we did it. Financially free, whatever, right? We're not doing investments anymore. We're gonna pull money out. So if you go down that column, it's called your income column, 71,214. And we take that every single year until we die, or so we think we're gonna die, at, let's say, age 88, if you look at it, right? So we're going from age 70, 71, all the way down to age 88, and then we croak, and then voila. So, but we've pulled out all of this money out of the policy, and if you add it all up, it's way more than we put into it. So this is actually a secret kind of retirement planning strategy as well, and most people don't know that this part exists within it. All right, so let's go into the next part. I don't want to beat that policy too much. It gets too confusing. I'm just going to hone in. I'm going to hone in on the parts that I care about in the next slide. But this is ultimately what happens. Here's the magic of life insurance. So I tell people that there are 3 important things about hiring an agent or getting a whole life insurance policy. Sorry. The 3 most important things when getting a life insurance policy for yourself: 1, it's the agent who is providing it to you. If they don't know what they're talking about, if they don't know how to structure it for you as an investor, that's a bad thing. So the agent is the most important part. The second most important part is the company, and third is the product. So there's going to be an insurance company. You guys might know of some like Geico and New York Life and Allstate and State Farm, and those are the big ones, right? So there's all of these different insurance companies. Well, within those insurance companies, they all have individual products. So the product that you pick, the insurance company that you go with, and the agent who puts it all together for you, super important. So step 1, this is how we design life insurance policies. So life insurance policy, well, some of the money will go to death benefit and some of it will go to cash value. I'm going to give you an inside tip that other agents don't do. And the reason I'm doing it is because I care about you becoming a better investor. I don't care about getting paid on the commissions. That's not what's important to me. What's important is that I make you guys better investors. Most of you guys I know from the real estate industry. You guys are real estate investors. I want you guys to be better investors. I'm using the policies as a tool to make you guys better investors. I want you guys to realize the insurance policy is not the investment, okay? It is just a special checking account. So I don't want to ever hear you guys say, oh, well, my investments can beat the performance of that whole life policy. Why are you comparing that? That's like saying, oh, my investments can beat the checking account. Well, obviously, right? This is just a way to hold money. Okay, so now, the people who design insurance policies will dictate how much money goes towards death benefit and how much money goes towards cash value. That's super important. Most agents will make your death benefit as high as possible and your cash value as low as possible because they get paid on the death benefit. Crazy, right? So of course, they're going to try to milk you and boost it way up. I'm going to minimize the death benefit, maximize the cash value so that you get the most living benefits. And that death benefit, that's just the icing on the cake. That's later. Now, if you want death benefit, you're still going to have it. But I'm going to minimize the death benefit and maximize the cash value. It needs to have death benefit in order to be considered life insurance. Without the death benefit, it's not life insurance. And I'm going to show you why you care about that at the end of the slides. But I'm going to structure it where 70% goes to cash value, 30% goes to death benefit, okay? So, and then that death benefit is going to be for your whole entire life. So some people think of things in term, like term insurance. So this death benefit is going to be like term insurance, but for your whole term of your life. So that's what's really cool about this. All right, so let's go and focus into what I care for you guys to look at. So you guys remember in the policy that I showed you, $12,000 was paid to the premium, right? You guys remember that, right? $12,000 was paid in. The way I just told you, 30% is going to death benefit, 70% is going to cash value, okay? So here's what's cool though. So on the left graph is the cash value, and then on the right graph is the term insurance. So let's start with the right graph first. 30% of the 12,000 is $3,600 a month. Or I'm sorry, a year, $3,600 a year. What that means is you're going to get $516,640 in death benefit. And that's going to stay fixed, right? As long as you pay your premium, we're just going to pay that. It's a flat fee of $12,000 a year, but $3,600 goes towards death benefit, and that's for the rest of your life, or that's going to buy you insurance for the rest of your life. And you notice the death benefit is going up. So I would say that that death benefit is becoming more and more and more valuable. Oh, just to be a little tangent conversation, you know what's really crazy? Some people will go to you when you're in your 60s or 70. They will look at your death benefit and say, hey, I will give you money today if when you die, that death benefit money comes to me. So you can sell your death benefit. I think it's called a viatical arrangement or something like that. But people invest into your policy by giving you money. They're buying your death benefit. So if you see at the end of year 20, it's 1.277 million. Somebody might come around and say, hey, you're 70 years old. Would you like, I don't know, let's say $250,000 right now? And then you go, you know what? I can use $250,000 right now. So you're like, fine, give me the $250,000. And then when you die, they pay you. The death benefit is going to be paid by the insurance company to the person who gave you that $250,000. So different people on this call who are always looking for a policy, or I'm sorry, an investment. Here's a new one that you might not have thought about. You can talk to old people and say, hey, do you need money? I'm willing to give you money today. And if you pass at some point, that pays me. Okay, so that's the death benefit part. I just wanted you guys to see that and cover that part. If you go to the left side, this is the cash value part. So now 70% of the 12,000 is 8,400. So that's the contribution every single year there, right? But if you guys look at the cash value from the policy that we showed you, 8,400 goes in, your cash value is 9,471. But what's cool is it starts to snowball. You put 8,400 a year again. The second year, 10,374 goes in. The third year, 11,550. The fourth year, 12,934. If you look at it from a rate of return, you're getting 12% year one, 23% year two, 37% year three. It's growing at a massive clip each time. So your total cash value, that's the last column. That's the total in your cash value that you have that you can play with. It's a really crazy thing. And so I said in the beginning that I wasted many, many years because the sooner you start this, the sooner you get to the later numbers. You see how big those numbers start to get and how little you contribute to it? It's nuts. This is why I wanted to share it with you, because that cash value you can use for later periods. And so I'm guessing you guys understand this. I'm going to go back. And I want you guys to see your policy. So here's the policy. So if you look at the cumulative, at year 5, you put in $60,000 total. That's $12,000 every single year. You're getting death benefit and you're putting away towards cash value. If you look at your total cash value, it's $58,174. It's almost break even without including the death benefit. You paid $60,000, you have almost $60,000 in your cash value, and you have death benefit, right? So it's cool right there. But then year 6, you're beating your cash value is beating how much you paid, and you still have death benefit. Don't forget about that part. And then it grows and grows and grows and grows. And it just keeps on growing all the way until you die. Now, we don't know when you're going to die, but we can design the plan to be where maybe you die at the age of 88, as this demonstrates. Maybe, maybe not, right? So that's what this is demonstrating. Now, back to it. So this is what I wanted you guys to see. This is why I got so excited, why I decided that I need to educate you guys in terms of this. Now, the question is, how do I use it? Super simple. So you guys are real estate investors. Cool. The cash value is the way we play with this policy. So now we don't want to take the money out of the cash value. We want to borrow against it so that the cash value keeps growing. Because if you pull the money out of the actual cash value, then you're starting the clock over to day one, right? If we go back to this, you notice how the returns grow, like percentage-wise, they get bigger and bigger and bigger and bigger. Well, if you pull that money out, you start back at day one. And that's not what we want. We want this crazy growth. And you see, year after year after year, it goes higher, right? It goes higher. So let's see. Let's go into this. And now, I know I'm going really fast. I can see the comments. I'm going really fast. I will go back to everything. I just don't want to lose my train of thought right now. But I want you guys to see it. I want you guys to understand what I'm talking about. And then we can answer any questions that you guys have. So that cash value is growing. Boom, 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 boom. All right. Now, what you're going to do is you're going to borrow against the cash value. You're going to take a loan out. So somebody, it's like a wealthy person says, oh, you have collateral? I'll give you a loan and I'm going to put a lien on your collateral. Same thing as a house, right? If you go to get a mortgage for a house, the bank is going to say, okay, I see that you have a valuable house. It's worth $100,000. I'm going to give you a loan for $80,000, right? And so the value of the house didn't go down. You still have the house and it still appreciates at whatever value it appreciates at. So this is the same thing. You're going to borrow the cash value from your property, or I'm sorry, from your cash value. You're going to borrow the money. You're going to get a loan. And then you might combine that with bank money, hard money, credit cards, your IRA, because you can do a partnership. You can do, what else? Your private money lenders, right? You can combine the loan that you get from your cash value. You can combine that with something else, and then you can go buy a property. So then what happens is you see the dash, the dotted line. That's the cash flow. So some of the cash flow goes to you. That's you hiking, because we're all about that free lifestyle. That's you hiking. You're going to get some of the cash flow. And then some of the cash flow is going to go to pay back the loan against the cash value. Okay, so you're going to use that money to buy the property, and some of the cash flow is going to go to you. So you're going to be using this as your personal piggy bank. The cash value is growing and growing and growing. You're going to take money as a loan whenever you need it to go buy properties. You can combine that with other sources of money like bank money or hard money so that you can go do your deal, because you might not have a huge cash value yet, and that's okay. You're going to have whatever you have, use whatever you have, and combine it with the bank money. And every single year, your cash value is growing at a very fast pace. A second example is right here. It's where you're hiking. You don't care for real estate, right? Some people are starting to realize that they don't like real estate. They much rather invest in notes. So what you're going to do is you're going to lend that money to the investor. The investor is going to buy the house. The investor is going to get cash flow. They're going to pay you back 12% because you lent the money at 12%, and then you're going to pay back your loan at 5%. You're going to make the difference. You're backpacking. You're not doing any of the work. The investor's doing all the work. So you're using your cash value that's growing at 20%, 30%, 40%, 100%, 200%. You're paying it back at 5%. And you're charging 12%. So you're making cash flow without doing the work, simply by being the lender to somebody who wants to be the real estate investor. All right. And so now here's what's a really cool one. So for all of you real estate investors who are creative, right? For all of you guys who are creative, some of you will buy properties subject to, okay? So for those who don't know what that is, reach out to me later. Subject to is where you buy a property from a seller and you leave their mortgage in place. The thing is, that mortgage has this clause that says that because the property got sold, we can call the mortgage due. So what you can do is, as long as you have enough in your cash value, you'll just wait. If the bank ever calls the mortgage due, you take a loan out against your cash value and you pay off the mortgage. So it's subject to a safety net. So for that one, real estate investors, if you guys have been in the business for a little bit and you know about creative strategies, you know what I'm talking about. There's this clause, subject or due on sale clause. You just have this money in your cash value as a safety net in case the bank calls the note due. If they don't call it due, then leave it alone. Just keep paying it down. But if they do call it, boom, you got the money, you pay them off, and then you refinance and you pay your loan back. And so then you get your own financing. It's a really cool strategy. This is how I've been telling people about investing in real estate in these times. People are going to be losing jobs. They're not going to be able to pay for their properties. They're going to have mortgages on their properties. Just say, hey, I'm going to buy your property subject to, buy the property, pay the mortgage on a regular basis. And if ever that mortgage is called, then you have the money to pay it off. All right. So that was, let me see. Ooh, let me stop share. Welcome back, everybody. That was a lot. That was a lot. I want to show you guys one other thing. I just came up with this. This is the one that people are going to steal from me, I think, right? So tell me if it's any good. Tell me if it's any good. Okay. So here is your checking account. Okay. So this is a bowl. This is a checking account. You got money and you put the money into the checking account as normal. The problem with a checking account is that it doesn't offer you guys any tax benefits. It doesn't offer you guys any protection. It doesn't offer you guys, like, anybody can see it. If an attorney wanted to sue you, they can see what's in your checking account. Stuff like that can occur, right? So it's very like vulnerable. So what do rich people want to do? They're like, oh, you know what? Hone was telling me all about cash value. So all they do, ta-da! See? So all of a sudden, it's the same thing. But now, it's backwards, I know, but this says life insurance, this says hidden, this says tax benefits, and it says accessible, meaning that if I need to get the money, I can go into the cookie jar. But if you wanted to sue me and you wanted to see all my assets, I'm like, oh, no, this, oh, no, that's the insurance company's money. That's not my money. That's not my money. I don't know what you're talking about. I don't have that money. That's not my money. That's the insurance company's money. Oh, look, it's in there. It's in there, but I get to use it. You guys see that? Somebody's going to steal this. I know it. Oh, it's not backwards. Oh, cool. It's backwards on my screen. But yeah, I get to use the money. I get to use the money to buy real estate. I get to use the money to lend it. I get to use the money for whatever I need to do with it. I want to buy a car, I get to. If I want to pay for kids' college, I get to. If I want to use that money in my retirement years, I get to. And I get to do it tax-free. I get to do it tax-free, right? So the money's in there. But if ever somebody's like, oh, we're going to go get Hone for his money, I don't have any money. I don't know what you're talking about because it's in here. It's hidden, right? Cool analogy, right? So yeah, someone's going to steal this analogy, I'm sure, but boom. That's how rich people look at it. They're like, oh, wow. I see. So then they think, how do I game the system? How do I minimize my death benefit and maximize my cash value so that I can do all the cool things that I look to do? How do I buy businesses, buy cars, buy houses, buy whatever it is, and yet still have my money protected? Rich people, I was saying before, they care about a couple of things. 1, tax benefits. 2, asset protection. 3, acquiring more assets, right? So those 3 things are covered by this policy. All right, so that's that. MC, how'd I do? And for everybody else, you guys can ask questions soon enough. Well, MC comes off of mute. Or can you come off mute?
Yeah, I'm off mute. Sorry, you were breaking up there the last second. I didn't. Oh
yeah.
Maybe it's my internet connection that's a little bit unstable.
So how was it? What'd you think?
That was great. That was great. And I think like the big thing here too, what you touched on is it's all about capital positioning. That's the thing. If you look at what is happening in family offices, for example, really, really ultra wealthy families and individuals are very cognizant in their advisors and their team about capital positioning, because they know and understand that if they position capital more efficiently and effectively to do more than one job, as part of their overall strategy, now you're snowballing and now you're getting into the multiplier aspect of things. And what I mean by that is most people would say put money somewhere in one specific bucket, and it only does one thing, where wealthy, very wealthy individuals and their advisors and their team will look at it and go, well, how can we position $1 in a certain area to do more than multiple things simultaneously? And this is what this does. So for investors and for business owners, the question becomes, the challenge to solve is, where do you put capital so that you have access to it to grow your business, and for real estate investors to grow your portfolio, have access to it, and also where is it that it's protected if you get sued, because you don't have to do anything wrong in the United States, unfortunately, to get sued. And business owners and real estate investors usually walk around with targets on their back. And then the other thing that ties into that is, not only do you have access to capital that's positioned to help you grow your business and your real estate portfolio, it's private in there, but it has other little things that it does too, protect you from taxes. It's got the death benefit that ties into family contingency plans, business contingency plans, which, we could talk about for an hour just on business contingency plans, but it does many different things. So I think the big takeaway for folks too is to understand that this is a tool, simply a tool, if used correctly, that could be very, very powerful to add and really add the multiplier aspect to what you're already doing.
Love it. MC, if you don't mind, I'm going to ask you the questions that were
Sure.
put in the chat box, and if you can answer them, that would be fantastic. All right, so first question, let's see, is, are these projections guaranteed cash value? And I'm going to add to that question, what have you seen personally within policies that you have written years and years ago?
Yes, so it's a great question. So what happens with mutual insurance companies that are not listed on the stock exchanges? So I'll give you an example. AIG is a stock company, right? MetLife these are stock companies, and there's mutual companies that are not listed on the stock exchanges. Now, who owns mutual insurance companies? Well, the policyholders are actually the shareholders in mutual insurance companies. Why is that important? Very, very important. Mutual insurance companies are managed on behalf of the people that own the company, which is you, the policy owner. So as an owner of the company, when the company is profitable, you get to participate in profit distributions, right? Or profit share, which is dividends that's paid out on these policies. Now, for anyone that's on here and that's a business owner, can you guarantee a profit in your business? No. But you look at the track record of companies. Now, insurance companies effectively are in the risk management business. So you look at mutual insurance companies that have been around for, since the mid-1800s, and you look at their track record, because they don't have to take on risks such as stock companies to meet quarterly earnings projections and, ring the bell and send out, reports to their stockholders. Mutual companies are managed much more conservatively. And they have a very, very strong track record. They have, most of them, the top rated carriers, have billions of dollars in excess cash reserves. And one carrier that we love to use, and that I personally use, they've paid out dividends since 1847 every single year consecutively. That means during the Great Depression, they paid out dividend distributions to their policyholders. That means that During the last financial crisis, they paid them out. So the projections that were shown is at current dividend scale. So it's simply a snapshot in time of where dividends are currently, which is between 6 and 7%. Now, is that guaranteed? No, there is a guaranteed portion in every single policy. It's 4% over the life of the policy. And then the dividends that are shown is at current dividend scale. Now, my personal experience, and I've done this for over a decade, over 10 years, is that this isn't an extremely volatile environment that they operate in and how they're managed, because it's very conservative. So if I look at illustrations that my illustrations of over 10 years ago, and I compare it to how it actually performed, it's pretty much in line, give or take a couple of $100 up, or give or take a couple of $100 down, because I have several of these policies. So I think the illustration that Hone showed is a very conservative just reflection. Could dividends go down? Absolutely. I mean, right now, I wouldn't be surprised if dividends go down a couple of basis points in this environment. But over the big picture, these companies have been very, very profitable. They continue to be profitable even in this environment, and their dividend scales are pretty solid. So I hope that answered the question. And then the second part of it was my personal experience, right?
Yes. Okay.
Yeah.
So what he's saying is, of course, it's not guaranteed. There is a guaranteed portion, but
Yes.
what was illustrated is a pretty close snapshot to what MC has experienced in his own policies and other policies that he has seen over the years. The next question is, when you set up a policy, can you request a 30/70 structure?
You can, but so not to get into the weeds, but there's things that we do even up front on that 30% that reduces insurance costs significantly. So even if you just go to a regular agent and request that, the chances be that they would still, that 30% that's allocated is not structured as efficiently as it could be, because we use a couple of riders to reduce the insurance cost overall. So I'll give you an example. Just the policy that I saw this morning too, let's just say it's $10,000. Let's say we use the 70-30 split on that, right? If they had to, which that person got, let's just say $7,000 went straight to cash, the $3,000 went to the insurance part of it, right? Within that $3,000, the whole life portion of that still was not the full $3,000, because we added a different rider to reduce the overall cost. If you had to build that whole policy on whole life, the effective cost would have been $6,000, not the $3,000, because there's many moving parts here. So yeah, so I guess the short answer is, yeah, if you just go to an agent and request that split, it's still not going to be the most effective one, because there are certain things that you have to tweak on the insurance side to make sure that it is as cost effective as possible. Because essentially what you're trying to do is, the goal with this vehicle is to position capital, a savings vehicle, right, with a death benefit to it. If you're looking at just straight insurance to protect certain things, which you need those for certain contracts, right? If you do buy-sell agreements for businesses, if you have other investors that's part of a project, that's a different goal. This goal is a place to park your cash. So, I would just say it's not as easy as that. The agent that you're structuring it is very, very important. Their knowledge of how to do this is very, very important. And their worldview, by the way, is very important too, because if you have the worldview of abundance and you're building your business on that, you're going to structure policies much, much differently. And then the other thing that I'll also say is the company that you structure it with is also very important, because yes, if you look at the top rated carriers, there's a handful of them. They're all names that we know, the top rated mutual insurance carriers in the United States, but then some of them have specific vehicles that allow you to do what we do, and some of them don't. That's also very important.
Okay, so what I heard was that yes, you can tell an agent to do a 30-70 split, but behind the scenes, there's much more that's going on. It's not simply just 30-70. I did that to give you guys a visual. Behind the scenes, there's a lot more tweaking that's involved because the death benefit is going to be made up of a couple of different pieces. There's the death benefit within the whole life insurance policy, and then there's additional riders that we put in there so that the policy looks like a life insurance policy. If you tweak it the wrong way, it's going to be out of whack in terms of ratios and not be considered a life insurance policy. So again, we're interested in this lid, right? We're interested in this lid, but you can only put the lid on the pot if you have a certain amount of death benefit compared to the cash value. So that's what's important here. The agent that designs it needs to understand that. So it's not simply just telling the agent that you work with now, oh, do it 70-30. Won't work that way. But
I'll also just one more comment. So I do a lot of speeches, and I've been interviewed on a number of shows, and sometimes I get interesting emails, as many of us do. But it usually goes like this: MC, I heard you do a speech, or I heard you speak on this podcast. I went to my brother-in-law that's an insurance agent, and he said, yeah, he'll take care of it. He set up the policy, and by the way, you're full of it, MC, because it's nothing. It doesn't look like it. It doesn't do what you said. I don't have any cash value. I can't access any money. I don't even actually have any money available within the first couple of years, so you're full of it. So what did that specific person do? They went to someone that didn't know how to structure it. They went to someone that is not appointed with the right carrier to set it up. And the carrier most likely didn't even have the vehicle to structure that properly.
Hey, Paul, how you doing today?
hey, Carla, did you mean to be off of mute?
Okay.
I'm guessing not. All right. The next question is, let's see. How is the interest calculated on the loan that you take from the cash value? How is that interest calculated? How does that work?
Moody's corporate bond average yield is the yardstick that they use. So it's 5% interest only annually. So let's just say on $100,000, basically it's $5,000 for the year. And the goal that we do in how we use it and how I personally use it is, this is my bank, right? It's my quote unquote family bank and business bank. So when I take a policy loan, let's just say that 100,000, it's 5,000 on that. The goal is to pay it back as quickly as possible because obviously it's adjusted in time, you know, when you basically pay it back, but usually on 12 months. You can pay it back scheduling on your own payback terms, which I think is also very important because if you're doing flips, if you're, you know, doing certain things, it's nice to know that when you take a policy loan, you get to set the terms of how you pay it back. You can pay it back right away. You could pay it back over time. You could wait at the end of the year until you've completed that flip. Personal story, when I started my firm 5 years ago, I took a policy loan to invest in all of the infrastructure. So all of the equipment, technology, and so forth, I used to purchase from my policy. It took me a while to pay that back. So I think it was like, 7-8 months or something. I paid back the policy loan, but I didn't make small payments too. I just paid it back until when the company became profitable. Now imagine you went to a bank and say, Mr. Banker, I'm going to borrow money from you to start this company or build this company. And the banker said, okay, when are you going to pay me back? Well, I'm not quite sure. Maybe about 7-8 months, you know, I'll pay you back some money. But I'm good for it. I promise I'm good. I'll pay you back the money. They'll laugh you out of the bank, right? So it just gives you a little bit more control over your cash flow. It's a tool that you can utilize to do that.
Awesome. So what I heard was that the interest was 5%, but the cool part is you don't have to pay it back every single month. You don't have to pay it back at the end of the year. Here's the cool part. You don't actually have to pay it back at all. And if you die with that loan, your death benefit is just reduced by that loan amount. So it's a really cool thing. And like he said, it's 5%. Imagine taking out a hard money loan. They're typically charging 10 to 12%. So 5% beats that. Now, you're still going to be using hard money loans at times because maybe you're buying multiple deals and you don't have enough cash value in there. So you're going to use the cash value loan for your skin in the game, because some lenders want you to have some skin in the game. So you use that part for maybe the first draw, for the closing costs, if the lender needs you to put any down payment, or if your deal isn't within the 60 to 65% loan to value, and then you still leverage the hard money loan. And again, when the deal is done, pay back the loans, pay back your hard money lenders, and pay back yourself, pay back your cash value loan. So, but the cool part is there is no structure, whereas a hard money lender, they want you to pay every single month. Your own loan, you don't even have to pay it back ever if you don't want to. You should, but you don't ever have to. All right, so let's see. Next question is, can you also use the insurance money to be a hard money lender? Can you be a hard money lender with this? Yeah.
Yep.
That's an easy one. The answer is yes. The second picture I showed where you were lending the money, voila, that's you being a hard money lender. You can charge points, you can charge interest, you can charge all of that kind of stuff if you like. Good question here. Once you start this policy, how soon until you can take a loan out from it?
Within a week.
Look at that. That's awesome, right? So you put the money away, within 1 week, you can access it. The problem is a lot of people have dealt with not bad agents. I don't want to call them bad. They're just maybe, they don't know as much. They will say you want a policy that doesn't have cash value for 2 years, 3 years, whatever it is. That cash value will say 0 and 0 and 0 for years. And so you can't borrow 0, right? You can't borrow anything if it's 0. Our policies that we design, you will have cash value immediately. And from that, you can borrow against it immediately. So it's a really cool thing. So I don't want you guys to think that if you buy this policy, you're out of money. You buy this policy, you have cash value that you can still access. So it's not a this or that. It's this and that. So it's a big difference.
Yeah, you get to have your cake and eat it too. And the other thing that I will just add to that too, again, to Hans' point, is I've made a presentation and 2 people came up to me afterwards that were insurance agents and said, you can't do that. It's impossible. So, well, I've done that for 10 years. So personally, so I know that's what we do. So again, it's just, you know, I would say like the big takeaway too, and you talk about this a lot, Hon, essentially, like with real estate, there's certain type of investors, right? There could be a property that somebody purchased and it's a disaster. It's a complete disaster. And then that investor has to sell that, and eventually another investor comes over, buys that exact same property at that exact same location and turns it into a cash flow machine. What is the difference between the two? Is it the property? You know, is it the, you know, all the other things around that property? No, eventually it was the type of investor and the strategy that the investor used. The same way in life with all asset classes, paper assets, which there are many of them, insurance just being one of them. You know, there's different types of strategies and different levels of strategies. So this is just taking it up a couple of notches.
I love the people who say, oh my God, you can't do that. Like I do all kinds of crazy strategies when I buy properties. I use credit cards to buy properties. They're like, you can't do that. I did it. They're like, well, what about the interest? I'm like, it's 0. I used the promotional period, right? And so it's just because they can't do it doesn't mean I can't do it. And other insurance agents will say, you can't do that. That's not how it works. It's that they can't do it or that they don't know how to do it. Just so don't allow other people's limitations to be your limitations. That's, I guess, the moral of that little story. Don't let other people's limitations be your limitations. Next question. What's the name of the insurance company that pays the dividend since 1847?
Yeah, it's the carrier that we use, Penn Mutual. And again,
Penn Mutual.
Yeah, Penn and again, Mutual. Yeah, we use them a lot in a lot of the stuff that we do. One of the top-rated carriers, and one of the reasons is the flexibility that they allow too. Being one of the top-rated carriers in the industry, so there's a handful of them. They're all great, but you have to figure out which one fits into your specific strategy and what you're looking to do. And again, you have to set it up with the right agent. You can call Penn Mutual and find someone, and again, they might not even know how to structure it. I know because I train two of the illustrators that I work with at Penn Mutual of how to do this.
Right. The it's interesting because the like MC was saying, you can hire an agent that works with Penn Mutual, but if they don't know what they're doing, then if they don't know how to work within what they have, they're still not going to be able to deliver the product. For example, a lot of you guys are are within the real estate school that we have, or the real estate group that we have, and we know that you guys can pay your kids $12,400. And the reason we know you pay your kids $12,400 is because the standard deduction is $12,400. So we're making it so that when you pay your kids $12,400, you get a write-off off your business. They're getting a write-on, right? They're going to have to pay taxes on that money, but they have a standard deduction of $12,400, so it's zero. So they pay taxes on $0, which is zero. And then for us, we have a $12,000 write-off. This tax code thing is available to everybody, but not every CPA will be able to tell you to do such a strategy, you see? And so that's what we mean by the rules are there for everybody, but if you don't know how to navigate within the rules, then you're not gonna do the same things that MC and I are constructing for you. All right, so let's go, next question. Are there any restrictions to investing with whole life policies, like prohibitive transactions? So I think the question more so lies with like self-directed IRAs where there's prohibitive transactions and all that. The answer is no, because this is not that. This is very different. You're borrowing the money. The money is yours. You can do anything you want. Is that correct?
Whole life policies have been around a long time before qualified retirement plans, 401ks and IRAs and all these. So it's, yeah, this is completely separate. The reason why this fits in so nice with real estate, and if you look at the tax code, it's actually pretty comical that they're very, very similar structures. And that's the rich write the rich write the rules, right? So if you look at the way that these two things are kind of put together, you get the full benefits of the policy and take the policy loan on it, and then get the full benefits of all the real estate that you're involved in, because it's not inside the policy. And the policy, you have full control over it. It's your money. You don't have to ask anyone permission. All you have to do is fill out a one-page sheet, send it to the insurance company, and if you have cash value that can be collateralized, they'll issue you the policy loan and send you a check or do the ACH. So you're not playing in the sandbox of Uncle Sam anymore. You're playing in your own sandbox.
There's a visual. Back to the bucket, right? So the bucket, my life insurance policy, has the money in there. So this is the life insurance policy. What's going to happen is there's money in here. There's value in here. The insurance company is going to give me a loan, right? And so let's say that the insurance company provides me a loan. Okay, so they're going to issue me a loan. So I have a loan. I did not actually touch the cash value that's in there. It's just collateralized against, right? And you guys understand that, the difference, right? So this loan that I got from the insurance company, I get to do whatever it is that I want with the money. The money that's in here is growing automatically. I don't need to self-direct this. I don't need to do anything with it. And actually, you can't do anything with it. The insurance company does everything for you. So when I was first learning about this, I was getting a little confused. I was like, do I have to invest that? Do I have to buy real estate with that or whatever? The answer is no, you don't do anything. It's super passive. That's the cool part. It's real passive. You don't do anything. They say real estate's passive. But when that window breaks, guess who they're calling, right? So that's not passive. This is really passive, where you can't even decide what to do with the money. All you can do is take the loan out against the money, and you go do whatever you want with this money, whether it's buy real estate, buy cars, buy businesses, buy groceries. Up to you. That's your money, so no restrictions.
And to tie into that, the collateralization, there's many other things that you can do, but this is my favorite go-to for all the additional bells and whistles. I'll give you guys an example. So one of the things that I also do is I have some gold, but I can collateralize the gold holdings. It's a company which allows me to do that. So I can borrow against that, but I can only get up to 50% of the value of that, number one. Number two, there's no guarantees of any growth in the gold. There's no dividends that is paid tax-free. It doesn't grow tax-free. When I sell that, there's actually a tax bill waiting for me. It doesn't provide a death benefit. And even though, yes, you can borrow against it 50% of the value, which 90% of your cash value is available in this, it's not as liquid as this. And, it takes a little bit longer. Usually a policy loan, I would say 5 to 7 days, but in my experience, it's more been 3 to 5 business days is the turnaround on that. It takes much longer with others. So if you look at collateralization strategies, this is a very, very powerful tool, but it's the same as the other ones where you don't actually touch the money in the policy. You collateralize it and then access it through a policy loan the same way, you do through HELOCs, the gold strategy, asset-based lending as stocks. There's even guys doing stuff with crypto now. I mean, you think of anything that you can collateralize, it's available. Business line of credits, collateralized by receivables and the assets of the business loans.
Right. So it's kind of like if you had stock and you didn't want to sell your stock, but you needed some money.
Yep.
You might go to your rich friend and say, hey, I got all this stock. Can I borrow money? And if I don't pay you back, you get to have the stock. Same thing. Right?
Yep.
So same kind of thing. Next question. Can you lose any principal money over time? Can you lose the principal?
No.
That is the guarantee part. That is the
never
guarantee.
Goes back. So once it's rolled up and dividends are paid, it never goes down. So when the markets went down 30 to 40%, you should have seen my inbox. It was just great news. It was beautiful emails coming in from all of our clients saying, I got a heart attack when I looked at the stock market and then logged into my account, and it's there, all of it. It hasn't gone down a cent. I said no, because that's why you have it.
Yeah. All right. So next question is, how would this work? Let's see. How this would work with or what you suggest. Okay. So they're talking about a convertible term policy. So
yes.
What is a convertible term policy? How would you describe a convertible term?
A convertible term is a term policy that can be converted to whole life. It's a great strategy. It's actually one that I use as part of my overall strategy. You see a lot of people debate, again, back to how, the average person buys insurance, they debate whole life versus term. The wealthy folks and the rich families go, we use both. And because they do different things. So I'll give you guys an example. So let's just say there's a 30-year-old person that makes $100,000 a year. And this 30-year-old person has, let's just say, a spouse and 2 young children. An insurance company will look at that person and say, well, they make $100,000 a year. Their potential earnings at that snapshot in time, if they work to 65 and maybe 70, is $3.5 to $4 million. That's their potential earnings. And by the way, that's how you protect it, how you can protect it, right? So let's just say they won one of these policies, that person, and we structure a policy for them. And because it's focused on cash value, not death benefit, their death benefit only gets to, let's just say, $1 million for round numbers, right? Well, there's still a gap of $3 million, because if that person passes away, the spouse and the children will maybe get a check for $1 million, but by no means are they in a good position. That $1 million comes in, but they essentially lost 3 of that person's potential earnings. So what you can do, and this is what I personally do, is you can get a convertible term for 3 to add to your existing policy, and it does a couple of things for you. Number one, your future earnings is protected. It's like buying your net worth up front, basically. Number two, it's the most cost-efficient way to do it from an insurance standpoint. Number three, it protects you for 20 years, that convertible term, but it can be converted over to more whole life policies in 20 years without a medical, without another medical, which is huge. I had a friend, same age as me, 41. He had a cancer scare, melanoma. He's fine. They got They took care of it on his head. Like he's fine. He's healthy. He's cancer free. But there's no insurance company that's going to underwrite it. Had he had a convertible term, they would still honor that convertible term, and he was able to convert it to more whole life. So it's just part of like a big picture view of like, number one, full protection for your family. Number two, maximizing the policy that you have, but also giving you the ability to add more policies. Now, why would you add more policies? Going to make more money, right? Where are you going to put your money? Again, it comes to capital allocation. Where would you put money? And I prefer to put it in there because I know it's out of the Wall Street casino. It's out of the banking system, basically, in a mutual insurance company with a track record of being around for, over close to over 200 years. Think about companies that have been around that long. Not many. I hope that helps.
Yeah. So what I heard was you buy a term policy and you can convert it later. And then you also lock in the certainty that you can get a whole life policy later. So remember what I talked about earlier, guys? Term policies only have a duration, 10 years, 20 years, maybe 30. And then after that, you're probably going to be too old and can't afford the term policy. So you lock it in at that certain price. Now, in the course of 10 years, 20 years, 30 years, you might get sick. You might develop diabetes. You might get cancer. You might get all kinds of stuff that will not allow you to get whole life insurance later. So what you're doing is you're locking in the ability to get whole life at a future date and only have term now. And there's financial reasons why you might want to do that and all that kind of stuff. So if you're like, Hone, I just can't put away the money for whole life right now, great. Then let's start you with term, and then let's make you have the ability to roll it over and convert it into a whole life policy no matter what happens to you. Again, stuff develops in humans over time, and we don't know what's going to happen. So let's try to eliminate the uncertainty, lock in a term policy. If you can't do a whole life right now, lock in a term policy that can convert later. All right, next question. And we kind of covered this already. If you never pay back the loan, does the insurance policy take those fees from your death benefit when you die?
Yep.
And the answer is yes. Yes. Can I put money in the cash value only? Like, can I make an extra payment to principal on a mortgage payment? The answer is no. Right?
After you paid the insurance cost. So, let's just say you have a $10,000 a year policy and you pay the $3,000 up front, and then which our carrier allows you to do, the one that we use for the strategy. So you pay the $3,000, and then the rest for the year you pay into that $7,000. Yeah, you can then only pay towards the cash value, right? But you need to pay that $3,000 first. So remember, when we share the strategy, a lot of folks are like, well, that sounds crazy. It sounds too good to be true. What's in it for the insurance company? There's no deals in insurance. It's only math. And these guys are phenomenal with risk management. So think about it from the insurance company. Why are they allowing you to take policy loans, not repay them? Why are they allowing you to make flexible payments into a policy? Like, you have to think of the other side, in every transaction. So on the insurance side, they're covered two ways. They're covered, number one, by your death benefit, which they know that eventually all of us will eventually pass and they will be made whole. That's number one. Number two, they look at the cash value is collateral for that loan. So they're actually protected twice in issuing that, right? And when you make the insurance payments, like in that example, they allow you to then make flexible payments towards the cash value. Why do they do that? Because they already got paid their insurance premiums first. So it's a phenomenal win-win on both sides. We get to enjoy all of these benefits, but it's also important to understand that, yeah, they're a business and they're profitable too, and they manage risk accordingly too. So I just want to share that too.
All right, next question.
Can I add to that? So it sounds like, Honan said no, but it sounds like you're saying that yes, you can do that, right? Because there's no risk in that. Because if so basically what I'm thinking of doing is just taking all my cash reserves for all the properties and putting it in like a life insurance policy or multiple life insurance policies, like one life insurance policy per property, and just starting off like that, right? So there's going to be a huge chunk, in the beginning. So that's kind of where I'm going with that.
Hone was correct. You cannot just make money straight towards the cash value. So what I was saying is, when you make the insurance, so you're going to have, it is a life insurance policy. So you're going to have to pay the insurance portion. But what I was saying is, once you've made the portion, yes, you can make, let's use that example of the 10,000. If you pay the 3, yes, you can pay it directly towards the cash value for the rest of the year until the policy, until the policy anniversary, which is the following year, right? So then you make another 3, and then you can pay directly towards the cash value again. But you have to pay the insurance first. So Hone was correct saying you can't just pay it straight towards cash. There's some insurance.
Oh, yeah.
Yeah.
As long as I pay the insurance portion first.
That's correct. Yes.
I can pay whatever I want after that.
No, here's the thing. Let me chime in real quick. So MC is saying that your premium is $10,000 a year. And you're wondering, Damien, okay, cool, $10,000 a year, but can I put in $20,000 that year? Can I put in $30,000 that year? And the answer is no, you can't do it that way. Whatever your premium is, it's fixed. It's fixed when you set up the contract for the rest of your life. So you can't put additional. You can't go, oh, this year I flipped the house, let me throw $50,000 into it. You can't do that.
Yes.
That $10,000 is fixed. So if you make more money in the future, all you would do is just open up another policy, a separate policy, if you want to throw more money into it.
Okay, got it. Thanks.
Because the insurance company, so there's a ratio between the death benefit and the premium. So our job is to structure it so that it's according to all of the regulations. Because what happened in the 1980s was that people got very greedy, and they were dumping millions of dollars into this single lump sum with like 100,000. That's $1 million in with $100,000 death benefit. And for the first time, the IRS got involved in life insurance and said, this is ridiculous. It's still a life insurance policy. You can't just like blatantly park cash there with no death benefit. So our job is to still like figure out what the ratio is. And let's just say 10 was the max there that you can put in because of the death benefit. Now, if you want the ability to put in 20 or to all the way up to 50, we would have to get that up front. So you cannot do that, or start as the best way to do it is start a second policy. From a cost
I totally follow you now. Yeah. Thanks for that explanation.
And here's one other clarity point, right? If your death benefit and your cash value don't have the right ratio, what happens is they take the lid off, and it's no longer a life insurance policy. And if they take the lid off, they can't put they don't put the lid back on. Once it's off, it's off. And you don't get all of the protection that you've gotten before. All of that other stuff, you don't get that anymore. So you got to make sure that whoever designs these policies for you, that they keep the lid on, because they started cracking down, like MC was saying, on all of the people who are taking advantage of these policies. All right, so let's keep on ripping through. What if you're just starting out in real estate and don't have a lot of capital? What's the average price per month these policies cost? So I guess, MC, what would you say the minimum for a whole life policy for premium, either per month or per year?
It starts to make sense. Like if you could put $300 a month away, like $3,600, I would have to run the numbers based on age, gender, all that kind of stuff. But I would say, there's 3 types of folks that we work with, right? Some people start out, they're young, they don't have a lot of resources, they have a lot more time. Then there's folks in the middle with good resources and capital and some time. And then towards the end, there's folks with a lot of resources with less time. There's different strategies for all of them. But I would say, like I'd say to a lot of folks, you just start where you're at and you take one step at a time, building that bigger and better future every day. And like for $300 a month, you could get something like this started. So all of us have to start somewhere.
All right, well, great answer. And I would also like to say that don't look at this as like a either or, right? People think like, oh, I'm buying into this policy and my money is gone. It's not. It's a separate weirdo special checking account. that money is in there and you can access it. Okay, so let's see. There's another great question. Let's see. So I'm going to read it because I was trying to summarize it, but let's see. Clarification, please. If you simply withdraw from the cash value, your ROI percentage starts over from the first year, ROI percentage. But if you structure a loan to yourself out of the cash value, you keep the current ROI percentage. Oh, I get what he's asking. So yeah, if you're pulling the money out, yeah, you're resetting the whole clock. You're doing all of that kind of stuff. So all you're doing is you're taking a loan against it. Somebody else is providing you a loan. You're getting the money from someone else. So let's say I had stocks and I didn't want to sell my stocks, right? My stocks are in my TD Ameritrade account. And I said, MC, you got some money. Can I borrow some money? And MC says, sure, but I need some collateral. I say, oh, no problem, MC. I got all these stocks. And my stocks are growing and growing and growing because they're doing whatever they're doing. I owe MC money. And if I don't pay MC back, he's going to take my stocks. That's exactly what's happening here. I'm not changing how my stocks are performing because I didn't sell them. I didn't do anything with them. They're just sitting there doing what they do. MC is providing me with the money. Same thing is happening here, right? The cash value is sitting there. We never touched it. The insurance company is issuing the loan. I'm not taking it from my cash value. The insurance company is saying, hey, here's some money. So in this case, the insurance company is like MC in this regard, and the cash value is the stocks. So that's what it is. That's how we keep the ROI going.
So you're never loaning yourself anything ever. You're just using your account as collateral to get the money from the insurance company, right?
That's right. There it is.
All right. So is that 5%? That 5%, I'm assuming, goes to the insurance company. That doesn't go into your account. That 5%
Right.
that you use as an example.
Yep.
Okay.
Right.
All right.
Yep.
All right. Got you.
That's a good point, because there's a lot of stuff on the internet of people borrowing from their policies and paying themselves back, and that doesn't work that way. So it's actually a separate transaction. So your money is in one account for the insurance company, or cash value, and then they have a general account, which a portion of that they cut policy loans to policy holders from that general account, and then you pay the money back into that general account, which is one of their profit centers. So through a mutual, indirectly, you benefit because it's one of their profit centers of their company. So indirectly, when the company's profitable, you get a dividend distribution. So it's not taking money and paying yourself back, and paying, growing your account because you're, paying interest back in there. It's a little bit more different than that.
Great question, because a lot of people get confused over that one. But yeah, there's the clarity. I hope you guys see that. The money that you pay back towards your loans does not go back into your account because the money came from somebody else's account. It came from the insurance company's account. They're making the interest on that money.
Yeah. One of my coaches, I'll share a quick example with you. One of my first coaches, we're talking now circa 2003, was sharing with me the strategy that they did in I think it's the 70s, when interest rates were really high. They would, let's just say they had $100,000. They would actually go to the bank, their local community bank, and they would say, Mr. Banker, I have $100,000. Can I get like a CD with your bank? Because it was paying really good rates at that stage. And the banker would say, absolutely, of course. So they take this, they put the money in the CD, the $100,000, they get paid a certain percentage on it. Let's just say it's 10%. Then they would go back to that same bank and say, Mr. Banker, I have a CD with your bank for $100,000. Can I get a loan secured by that CD? And the banker would say, of course. I'm in the business of taking in capital and selling products there, and we lend a lot of money. So they would get a loan secured by that CD and then use it to invest in real estate. And they would obviously take it at a certain rate, even if it was like 8 or 9 or 10%. Let's just say they invested and get a 20% in their real estate and then pay the loan back. Now, in that transaction, you never touch that CD. It's the exact same here. You never touch the cash value like you never touch the CD. The money sat in the bank in that CD. You just collateralized that CD through a loan that you got from the bank.
Okay, this is my favorite question. so far. Hey, Hone, can you recommend an agent to set this up for me? Yes, I'm going to put an email address in the chat box. So insurance@honesloans.com. My favorite question of all. Thank you so much for that one. Thank you for that question. That was a great, great question. Okay. But the next question, real question, it's a really great question too, because it shows the power. So in our example, I had showed that at the ripe old age of 70, I was pulling out like $71,000 or $72,000 in income. You guys remember that? So there was this retirement plan and I was pulling money out. He says, when you pull the $71,000 of income out, is that going to be taxed as simple income? How does this work, MC? So how does this work, MC? That $71,000 that I was taking for almost 20 years, how is that taxed?
If you're a farmer, would you like to be paying taxes on the seed or the harvest? So personally, I like to pay taxes on the seed, not the harvest. So this is after tax money. So there's no tax write-offs that you get by putting money in a life insurance policy like an IRA or some. There's no tax benefits to reduce your taxes in that given year. This is all after tax. So the after-tax money is placed into the policy. It gets tax-free growth in the policy. The dividends are tax-free. You access money from the policy through policy loans tax-free. And then when you take distributions, as in that example, that money is tax-free because remember that you paid money on the seed, you pay taxes on the seed. That's the harvest. So you don't pay taxes. And there's specific strategies of how to do that, again, of taking the money out of that policy tax-free. I won't show the illustration. There's things that we need to do on the back end to make sure it comes out tax-free. But no, that was a tax-free distribution. So if you're a business owner or a real estate investor, you get to position your capital to fuel your business, fuel your real estate portfolio and your goals. And then also have a liquidity accessible. And then years down the line, if there's an additional income stream that you need, now you can tap into that. Obviously, the goal for a lot of us, and for me personally, is to never touch this, just to transfer this over to my kids and they to their kids and live off my other investments. But if you need additional income streams, you have that available.
So the answer is no, you don't pay taxes on it, which is amazing. So that $71,000 a year income, tax-free, unlike your traditional 401k or IRA where you will pay taxes on it because you got the tax benefit up front. So here's a really cool question that was sent to me privately, but it said, I am a licensed agent. So this person is a licensed insurance agent, and they said, I am blown away by all that I am hearing. Does your team want more agents? So I'm like, wow, that's really neat. So we're getting there. We're growing. Awesome. We're a very boutique firm right now, MC and I, right? We're a boutique firm and we believe quality over quantity, but we do plan to grow with good people. So MC, if you'd like to chime in on that for any other agent that might be on here.
Yeah, absolutely. And we're always looking for folks. What we do say, and the reason why we're small and mobile, so we've got 5 people right now that handle a lot of business. And the reason for that is in our niche, we work with investors and business owners. So we're very specific, the people that we bring on with our team too, that they are real estate investors and have been involved in business, because I just always have found it quite interesting that in financial services, and this is what I'm trying to personally change my mission, is you have people that have never invested in real estate and never been involved in business in any way, shape, or form, advising real estate investors and business owners. So that's the kind of different aspect that we're trying to bring to the marketplace that I think have resonated a lot with folks. So absolutely, we're always open to conversations, but like I said, for the people that we're serving, we want folks to be doers and to eat their own cooking, right, huh? Without throwing up.
Absolutely. Eat your own cooking without throwing up. So yeah, we create these policies, and this is the niche. Like MC is a real estate investor. I'm a real estate investor. We invest in real estate. Insurance policies are not the investment. And I want you guys to understand this. The insurance policy is not the investment. There are these insurance firms and all they talk about is how to sell more policies. It's not like that for us. What we care about is you guys become better investors. And so we're looking for agents who are also in that same mindset where when it comes to clients, we're really trying to help them become better investors. That's our little niche, and we're doing really great at it. All right, so next question. What happens if you can't afford the annual premium? And then there's kind of like a piggyback question from another person. How do you handle policies that could be high the first year, but then maybe next year you can't pay as much? So they're kind of similar, and they came from two different people. But what if you can't afford the premium that year? What would you do, MC, if you couldn't afford the policy?
That's a great question. And by the way, with investors and business owners, it's usually feast or famine with liquidity. So a lot of our clients, they either have a ton of liquidity they're sitting on, or they've got a lot of money out on the street in deals or invested in their business, right? So when do you guys think do most of the premium payments become due in a cycle for business owners and investors? When there's a lot of money out on the street and when they have less liquidity, usually. So there's a lot of options. So the first thing that we try to do, the goal that we try to help folks establish, is to set up 6 months of liquidity in their policies. Okay, that's the first goal, because by doing that, they actually get to save a lot of money in other areas, which I won't dive into a lot, but there's actually other areas of insurance that you can reduce costs by having 6 months of living expenses and business expenses in a policy. Disability insurance, for example, you can raise the time deductible, which is the elimination period, and save thousands of dollars. Deductibles on health insurance, deductibles on property and casualty, just low-hanging fruit right there. Having this established, you save money in that area. But having the 6 months of liquidity set up already too in the policy allows you to, number one, take a policy loan to pay the minimum insurance that's due to keep the policy in force. And then when liquidity comes into the investor or the business owner's economy again, they then pay the loan back and then fund the rest of the paid up additions, which is the cash value in the policy. So let's just talk through an example. Let's just say you have a policy where you have $100,000 premium per year, right? And the minimum on that, let's just say, is 30, right? 30,000. So what happens if something happens, like now the premium payments due, money is out on the street, I don't have $100,000. But if you have 6 months of living expenses or cash value in the policy, which we advise people to have at all times, now you take a policy loan for the 30, then the liquidity comes back. What do? You pay the 30 back and you pay the 70 in PUAs. So this happens all the time. Another thing is you can spread payments quarterly, monthly. So using that same example, someone could take that 30 and spread it monthly and pay the minimum monthly and then fund the rest of the money, the PUA, the cash value, throughout the rest of the year. Could do that quarterly too. What happens if the policy is completely stripped, which we would never want to do? You don't have cash value in there. You cannot pay the payments through cash flow, or you lost a job or something like that, for example. What happens then? Well, the last bit that you can do is you can actually take money out of that policy. Actually stick your hand in there, like in the CD, and take money out of the CD and actually access the cash value. You would surrender cash, is how they would frame it. And what that does is it just reduces the cost basis, which just kind of changes the game a little bit later on when we take money out of the policy for retirement distributions, let's say. But I think the key here is to understand that there's options. It's not just, oh, you have a large premium, oh, sorry, you're SOL. No. And from the third year in a policy, so let's just say you fund the policy year 1, you fund the policy year 2. Year 3, you don't make any of the cash payments, only the insurance, right? Well, in year 4, they allow you to go back to year 3 and catch up. So that's another feature. It starts from the 3rd year in those policies, but it's good to know that there's also catch-up provisions in some of these policies. So there's a lot of flexibility built into them. I hope that answered that question.
I hope so too. So that actually came from 2 different people. So if that was your question and you need more clarity, please let us know. Because the one said, what if you set up the policy that may be high the first year, but next year you can't deposit as much? So that kind of answered it.
Oh, okay. Yeah. What that question refers to, but next year you can't deposit as much. Yeah. So maybe it was not be able to make that same payment. So let's just say somebody has a lot of liquidity that's sitting in a bank earning 0.0, whatever. And they're moving that into a policy in year 1. And then the next year they can contribute the same amount, maybe. I would say that you can build a lot of flexibility into this without increasing the costs of the policy, which I like options. I like flexibility because you want to have the ability to make tactical changes to and pivot in certain ways in any strategy.
All right. Next question. What if the insurance company goes out of business? Is there insurance on the insurance policies for that?
Let's buy some insurance on insurance on insurance. That's a great question. Insurance is regulated by the state. So each and every state has an insurance commissioner, which they can perform audits. There's a lot of regulatory stuff that needs to be filed by these companies on a state basis. So the insurance commissioner can, if an insurance company is doing things that they're not aligned with, they can actually appoint someone to step in and run the insurance company on behalf of the policyholders and bump the CEO. So that can happen basically on a state basis. Then there's also guarantee funds that insurance companies pays in for every state. So depending on the size of the company, the amount of business that you do in the state, there's a ratio of how much money every company needs to pay into that specific fund, which is also another backstop. And then if that goes through, let's just say you have the state commissioner already appointed someone, the guaranteed fund needs to kick in and it's still too big to bail out, or there's still trouble. What happens is a carrier can come and buy another carrier. That has happened before. Not so much with mutuals, but with a lot of stock companies. And then worst case scenario, and I get asked this question all the time because AIG, the redheaded stepchild in the room, got bailed out by the federal government during the last crash. So I get asked the AIG question quite a bit. They're not a mutual insurance company, so they did a lot of very, very risky and nefarious stuff. But the federal government did step in to bail them out. Now, what I would say is when you look at the history of mutuals and where they are, like and especially the policies that have been issued by mutuals, they've been protected and have paid out. Especially the whole life ones, where you hear things and maybe read stuff in the news about life insurance companies pulling a fast one on people. That's more, I would say, universal policies, which have gotten a very bad reputation because of, we could talk for an hour just on universal policies, which a lot of agents have been running around selling like hotcakes in the 80s, but it was basically created the same time as 401ks because of all the things that it represents, participation in the stock market, that kind of stuff. So yeah, I hope that answers the question, but I think the short answer is that, insurance companies, especially the mutual ones, there's a lot of layers of protection to protect the death benefit and then also the cash value of policyholders.
So what I heard was you're more likely to to go under than the insurance company. So don't worry about it. All right. This one's not a question. It's a comment, but I want to comment on the comment. So the person says, I'm 28 years old and I have a term policy and IUL now. IUL stands for Index Universal Life. That makes me cringe. And the reason it makes me cringe is because an IUL, remember when I said that there's death benefit and then there's cash value? So the IUL, their cash value is tied to the index, so it's moving up and down with the stock market. Now, they tell you that there's a floor and a ceiling, right? And that you can never lose. Great. How much does that cost you, right? So if there's ever this kind of like stop loss, there's a cost to that. But more devious than that, the IUL has what's called a renewable term. Every single year that you get older, your insurance policy gets more expensive. So that term every single year is getting more and more and more expensive to the point where it might become so expensive that your insurance policy explodes. The cash value can't keep up with it. And so then what happens is you're about to lose it. Your policy is about to get lapsed. Remember when I told you guys about the people who invest in insurance policies, meaning they're going to buy the insurance policy from you? They're going to come up to you and they're going to like, hey, you're 70 years old or 60 years old and you can't afford your policy anymore. It's going to go away. You're just going to lose it. It's just going to be wasted money. How about this? I give you $250,000. Your death benefit of $3 million goes to me, and I will continue to pay your policy. So here's money. I pay your policy. Death benefit goes to me. A lot of people with IULs in the future struggle because they don't realize that this term policy keeps renewing and gets more and more expensive to the point where it explodes. And so that's the problem with your IUL. It's not that an IUL is a new policy. It was created in the 80s, I believe, and it hasn't been time tested. And so people now who bought in earlier are time testing it and going, oh, I didn't know. The agent who sold it to me didn't explain it. You know why? Because the agent didn't know either. Nobody knew. So sorry. Sorry that you.
No, it's fairly new, like you said, in the 80s. And there's a ton of lawsuits on that right now. If you just Google Universal Life lawsuits because of what you just explained, Hone. So that's why, because there's no deals in insurance. There's no deals. It's only math. So if somebody is promising, cheap insurance with, a floor of this and a top, basically, and a ceiling of this, there's certain things that you then have to look at. So what it is a lot of insurance companies wanted to get in on the Wall Street spike at that stage, because before qualified retirement plans, the average American did not invest in the stock market. It was more for rich people, basically. The 401k then was created, qualified plans, and I interviewed Ted Benn on my show. He was the creator of one of the first 401k plans, corporate ones. And what happened is this basically opened the opportunity for everyone that is basically employed to invest through a 401k in the stock market. So you had one of the largest stock market booms, and insurance carriers got greedy and looked at this as an opportunity to participate in that. Now, the universal life policies, whether it's IUL or VULs, when you're young, it can work like in your 20s, 30s, 40s, because your cost of insurance is still very low. But when you get older, in your 50s, mid 50s, late 50s, 60s, mid 60s, all of a sudden the policies become unaffordable. And you've heard people, and this is why there's a lot of anger, and rightfully so, towards a lot of carriers, because there's children whose parents would have passed, and mom and dad had an insurance policy that they knew of, and now the parents passed, and they're being told that there's no life insurance policy and there's no payout. What happened was the premiums started at like $10,000 a year, and all of a sudden it was 50 or 60. When they're older, it became unaffordable, and the parents just let it go, basically. So that's another thing. We do a lot of rescues, IUL rescues and VUL rescues, where we do a 1035 exchange. Very interesting. Real estate, you have 1031. Insurance, you have 1035. Where you can transfer the cash value that's built up in those policies into a whole life policies where the premiums stay level. It doesn't increase as you get older, and there's a little bit more solid foundations in that structured policy.
Is there a way that they can have a fixed payment IUL for the rest of their life? Is that a possibility that they have such a thing?
It all depends. I mean, we could talk about those structured for a while. It all depends. Yes, when there's older, there could be a certain amount of payments and it's paid up, but it actually eats into the cash value significantly because, again, there's no deals in insurance.
Right.
So what you give up in one area, you have to take from another area. So, I mean, technically, yeah, you can make a certain amount of payments and it's paid up, and then you have the cash value in there, but now there's still costs associated with that. And then also, I mean, the big thing that we're trying to do is control our capital and put our capital to use and control it. So being outside of the casino is essentially what you're trying to do. You're essentially not want to have your money or the control of your capital tied to Wall Street. And again, the insurance company have a bundle of stocks, an index of stocks, which, let's just say it's mutual funds that they have in there, or even if they just buy a straight up, index ETF or something, there's costs associated with that.
Right. So the other thing I don't like about the IUL is that there are extra costs that an IUL has that the whole life that doesn't have. So, but good questions. This person is asking, what's the death benefit on $300 a month policy? Well, it really varies on your age. It varies on how we set up the riders. There's so many variables. So we can't.
There's no cookie cutter policies. It's all based on the age, underwriting,
male, female,
smoker,
not smoker.
State's going to start differ because it's regulated by the state. So to give folks an insight, like New York, there's a lot of carriers pulling out of New York because it just has become so ridiculous to do business in the state of New York. And some of the carriers that stay there, guess what? The costs that were passed on to them will be passed through to the residents in New York. It's just how it works, right? So there's a lot of things that will impact that.
Right. So then next one is, I'm inspired to switch the insurance companies with you guys, Hone. What's the benefit of $100 a month policy? So MC, you were saying earlier that you recommend $300 a month at least, right? What happens at $100 a month?
Because it is insurance, it wouldn't make necessarily sense at that point. Maybe for children's policies, but like 100, I would say the first thing that you have to do is remember, this is only a tool. So a tool that can be very, very powerful, like a sword. A sword can be wielded a certain way and be very powerful and can protect you, right? But if you don't know what you're doing and you're playing around with it, it could hurt you. So I would first establish good foundational stuff to where you get to a point where you're putting away a couple of $100 per month comfortably before I even look at this. And the other thing that I would also say is, you want to have some cash on hand. So if you're saving, let's just say $100 a month, you don't want to put $100 into this. So the full 100, right? And that's the same for if you're saving $1,000 a month. You want to more look like 500 to 750 because you also want to have some cash on hand. This is still an insurance policy. It doesn't come with an ATM card. So those are just things to think of. Like, get all those other things in line first, and then when you're comfortable, because you want to be comfortable in putting away certain things and putting things in vehicles, right? So that would just be a recommendation.
All right, good answer. Okay, so what is the interest rate on the cash value per year? So the interest rate on the cash value per year. So I'm guessing the question is, how quickly is this growing? If you remember the screen that I had up with the illustration, in the first year of the 12,000, 8,400 went towards cash value, and then 3,600 went towards death benefit. The 8,400 went in, 9,471 was cash value year one. That's a 12.75% difference. That's 12.75% growth. You put in 84, you get out 94. That's 12.75. The next year, I put in the same 8,400, but my cash value grew by 10,000, which is a 23% growth. And then 37%, 53%, 64%. So the cash value is growing by a significant amount based on how much I'm contributing. But that's not the dividend. That's not how it's calculated and how it's said. But if you're just doing the pure math of how quickly is the cash value growing, it's growing year after year, and that interest rate is bigger and bigger and bigger. But I'm sure MC has a different way of phrasing that.
Yeah. So initially you're built, and this is by no means a get rich quick scheme. You're building up capital into the policy, and eventually you're going to be looking at, a 3 to 4% internal rate of return tax free. And then as the policy continues to build up momentum, which is the massive money times the velocity is your momentum, is you're going to look at 4 to 5% internal rate of return tax free. Now, a tax-free versus a pre-tax that you think about that at a 4 to 5%, after a couple of years, internal rate of return tax-free. What do you have to get pre-tax to get that money out, post-tax? So, but yeah, it's not by any means right off the bat you're now earning a ton on the money that you just put in. You build it up the first couple of years, and then eventually, as the policy builds up momentum, you're getting a nice return, tax-free.
From the illustration I'm looking at, by year 9, when I put in 8,400, the cash value grows by 16. Or I'm sorry, I'm putting in 8,400. It's growing by 16,000. So that is 100% return in terms of growth of cash value by year 9. So like MC is saying, it needs to build up momentum. And at some point, it is a freight train that is just growing like wildfire, right? All right. So let's go into the next one. Let's say a whole life policy starts at $3,600 per year. Could a convertible term policy be cheaper or start at the same amount? So the answer is yes. You can either buy a convertible term for $3,600 a year, or if you wanted the same equivalent death benefit, the term policy would be way cheaper. But remember, it's a term. It's a finite time, whereas a whole life policy is for your whole life. So that's why there's that difference in price. Also, term does not have cash value. So you pick and choose. And what's cool, MC was telling me, he has a term policy of, let's say, $5 million death benefit. So maybe you pay $3,600 a year. Maybe you can get a $5 million cash value death benefit. You can transfer like $1 million to become a whole life policy in the future. And then you can chunk it and do another million, and another million, another million. But when you did the term, you locked in the fact that you don't have to be medically underwritten ever again. That's the cool part. Because you may, I hope not, but you may develop some kind of something that causes you to be unable to be underwritten for insurance. So if that ever happens, you're going to be so thankful that you locked in such a huge death benefit with term, because you can always convert that later. Anything you'd like to add, MC?
No, that was well put. And that's the power of the convertible term. And what you can also do is you can reverse engineer a policy. What we did for a client, because he was in the process of acquiring a couple of practices. And what we did was he wanted a certain policy built, but he needed about 3 months before he was ready to start making the capital. And at that stage, going through the underwriting process, we put together a convertible term for him, which was converted 6 months later to the exact whole life policy we would have set up for him. So that's how he did it. Just for those, because he was already approved and ready to go and wanted to at least just lock in what he received, because there was also a change in insurance in the industry at that stage. But that's what it did for him. So you can reverse engineer it and figure out, and get the convertible term, and then get the whole life converted over when you're ready to do that.
All right, next question. When you want to take money out of your cash value around retirement age, is that okay? No penalty? So you get to take out your contributions. So over the years, you would have made contributions to it. We would take out the contributions in the beginning. eventually you will take out all of your contribution. So then there's all this cash value that you have there. So what we're going to do is we're going to borrow against the cash value as a loan that we're never going to pay back. So that money that you got as a loan, you're just going to use it as cash. And then when you pass away, your death benefit would just be reduced by how much money you borrowed. So it is no penalty because of the way you take the money out. How you do it is just as important as you doing it.
And that's why it's important to work with someone that has strategy behind it. And also, here's the thing is, it's not just the insurance policy, right? Because even if you get someone and they put together a policy and now you have a policy, now what? I know this happened to me when I got my first policy. My first policy was not set up properly. Then my second policy, I finally got an agent that set it up properly for me. And then I said, okay, so how do I use this now? I don't know. You mean you don't have one of these? you're selling Ferraris, but you don't drive one? You know, so the importance is the maintenance of the policy and then also making adjustments and using strategy to achieve objectives when you have the policy. Because that's very important, because here's another pitfall of this too, is you can set up a perfect policy. You could design it properly, but when it's not managed properly, it's still not going to do what you want to do. And I've seen, you know, folks have reached out to me and had it actually set up with another agent, which I know that other agent, and I know that he sets up the policies the right way and he does it properly. And he's a really good guy and has a great company too. So I appreciate what he does. But the issue wasn't that the policy was not set up correctly or wrong. The issue was that it was not managed properly by the person who was the policy holder. So you do need ongoing just guidance of how to use this, and especially at the back end, when you start to take money out of this, you know, it's one of those disclaimers that you want to put in. Kids, don't try this at home. Don't do it by yourself. Have a professional help you with it, because not to get too technical, but you have to draw down the cost basis and then switch it over to policy loans to get the money out of there tax-free without penalties.
Awesome. Okay. Are your premiums fixed through the entire policy, or is there a way to set up the fixed premiums? And then also, if you want to have more insurance, can you start paying more? So that's kind of like the question we had earlier. It is fixed. So if you want to have more insurance and you want more money to be dumped in, you start another policy. So it does not have that flexibility of premium in that regard. You can pay it over time. You can pay like minimums and stuff like that, but whatever that fixed amount is, you gotta pay that amount and you can't do more. So here's a really good question. Do these policies have a minimum age requirement? For instance, can a parent get a policy for a child? This is a good one. This is a good one. And let me answer this quick one. People sometimes think, wait, you're buying a policy for your child? Do you think your child's gonna die? It's like, no, I think my child actually is going to live, and my child's going to live for a very long time. This is to build up the cash value in the policy. It's not so that I'm thinking my child's going to die. I'm setting them up for the future so that they have cash value, so that they have their own bank, so that they can go do real estate deals out of their cash value. So MC, please.
Absolutely. This is one of my favorite things to do. And it's not profitable for our business, but it's so amazing to do for the family and for that child because of what it does in the life of that child. So both of my kids, both have 2 policies each, and you can start to underwrite a infant legally. I think it's like after 15 days. So on the 16th day, I filed the paperwork for both of them to get their application started, because I know what it does will do in their life. So if you compare this as a savings vehicle to anything else out there for them, it's really a no-brainer. You have control over the capital because you would be the owner and the payer of the policy. The child would be the insured. The money would accumulate in that policy for the child. And through the very different stages, it could do different things, right? So, for example, you know, let's just say that they want to start driving, you know, they're going to need a car purchase at one stage. There will be money in the bank, which is part of the family bank for them. You could teach them how to repay that and be their own banker. If college is still a thing when they go, like I look at my kids, I'm like, I don't know if it's going to be a thing, but they're very young. But if it's still a thing, there's money in there for them for college. If it's not, then there's money in there for them to start a business, to invest in real estate. And then, as they continue to maintain the policies and maintain it, there's money in there for all different phases of their life. And also for the when I'm no longer around and I've been in the ground a long time ago and the worms have had their way with me, I know that they're going to be taken care of on the back end of their life, because I know by setting this up what income will be available from their policies tax-free to them. So compare that to any other vehicle that's out there. It's a no-brainer because you have full control over that capital, and it can be used for whatever you want to use it for. It's like a 529 or something like that, which is strictly for college, which if they don't go to college, you can assign it to someone else, or you could cash it out, pay the penalties and the taxes, and it's tied to the market. So it's very rewarding, because now you're starting to talk about family banking and family philosophy and transferring something that you've learned over to your child.
So the answer is the minimum age is 16 days old. And yes, you can buy it for your children. And it's a really good reason. There are many good reasons to do so. All right, so we have a clarity question. When you say manage correctly, if you are paying your policy every year, is this enough to maintain your policy, assuming I'm not looking to take out loans as of yet? So I guess they want clarity when you were saying earlier, manage correctly.
Yes. What I mean by managing correctly is Nelson Nash, that wrote the book, Becoming Your Own Banker, who's a mentor of mine, just a phenomenal human being. He passed not even so long ago. But Nelson talked about, Nelson talked about that you have to be an honest banker. You have to be your own honest banker. So clarity, what does it mean setting up your own banking system and being a dishonest banker? Well, what Nelson was saying was managing your policy is paying your premiums. That's good. And if you don't touch it, that's fine. Then you keep building up that bucket of money. But when you take policy loans against it, he was just saying that you don't want to completely strip it constantly, strip down the policy and have, completely over leverage it and then not paying it back. There are some folks, I've seen some policies where they completely strip the policy. They just let the interest stack on and roll into the policy loan. They don't pay it back. And then all of a sudden, there's going to be a drag on your policy eventually overall, because you're not using it. You're not using the tool the right way. The right way to use the tool would be to fund the policy, collateralize the cash value, invest it properly into your business or for real estate, make payments back just as you would replenish a bank account that you have, replenish that your own bank again, and do it over and over and maintain some reserves in there. Now you're an honest banker. So I think that's kind of the clarity. When you run into issues is when you strip it bare, you don't pay it back. Nelson was jokingly saying in the book too, he was using the example of a supermarket. And he was saying, you don't want to steal, cans of peas out of your own supermarket. You actually want to put the money in the till, even though you own the supermarket, when you take the peas out the back. So that was kind of his example. So that's what I mean about proper policy management is, again, it's a tool that can be very, very powerful, or it could not do what you want it to do because you're not handling it properly. If you strip it, again, not to go on about it, but if you strip it bare and you run into issues, for example, payment issues. Now you've stripped the policy bare, you haven't made any policy loans back, and now you're in a situation where, now I'm in trouble because I have to pay some insurance costs, but I haven't really paid anything on the back end, so there's nothing inside the policy technically, even though the cash value is still there.
All right. So if I don't have any real estate at the moment, is that okay in terms of setting up a policy with this structure?
Absolutely. We have a lot of different clients across the country, and it's not just real estate investors. We just work a lot with real estate investors because I'm one myself, and we find that real estate investors understand cash flow when you're working with them. So no, you don't have to be a real estate investor.
Right. This cash value, again, it can be used for anything. If you want to buy a car, you want to pay for college, or even if you just want to create a retirement account, it is a retirement vehicle when used properly. And this design has that retirement feature. So there's so many ways you can use it. If you want to buy a house to live in, this could be your down payment. So there's so many ways to use this policy. You don't have to just be an investor. MC and I just happen to be investors, and we like dealing with investors because we know what you're going through. We know the cash crunches that you guys get into. We know where your sources of money come from because we do all the same thing. And so we now can strategize with you on how do you do more deals by using this tool.
And the other thing that I would also add to that too, Hone, is it's very important to know that you are, and this is all about accountability and responsibility and taking ownership of everything that we do, which everyone on this call already does just by spending time with us. But it truly, truly comes down to that. And you have control and power over this tool. So it's almost like that moment in Spider-Man where Peter Parker was sitting in the car, and I think it's his grandfather that got into the car with him after Peter Parker realized that he was Spider-Man. And his grandfather, I believe, said something to the effect that, you know, with great power comes great responsibility. So you don't have your 401k plan administrator telling you what you can and cannot do. You are in charge, but with that comes great responsibility. For me personally, you know, I can speak to that. Like, it's made me a better business owner and a better investor having this system in place, because I know that what my cost of capital is. So if my cost of capital is 5%, and this is how banks think about it, what decisions would you make as far as the investments that you make in your business? And what decisions would you make as far as the decisions that you make in your real estate investing business, right? You start to see the world through a different lens because you understand your cost of capital, which everyone has a cost of capital. Most people just don't know that. You know now through your policy, so it's going to change the type of decisions that you make, you know, instead of just drawing money out of there and just, you know, going to Vegas when it opens again, I guess. You're going to look at it more from a worldview of, okay, this is what it's costing me. I have to put this capital to work for it to be effective.
Awesome. Question is, if you stop paying back your loans, will they stop building your cash value? Like once you pay it back, will that decrease the cash value or put you in overdraft because you never paid back your loan? The easy one is, your loan does not affect your cash value. That's why you took a loan, because you're not touching your cash value. The cash value is building independently. You took a loan out against it, securitized by the cash value. The loan is separate. You don't pay that back, your death benefit gets reduced, but the cash value keeps growing. Is that
Yep.
Okay. All right, cool. That believe it or not, that was the last question. People kept adding questions as we were going through, so it just kept on going and going and going and going, right? But no, this was great. If you guys are interested in starting a policy because you see the value, I would say reach out immediately. Again, you guys can email me or message me, however you guys know me, message me that way, and we can get started. The thing that I said earlier was that I wasted so many years because I just never did anything because I didn't understand the power. So now that you have been given the information, if you do nothing, it's like this whole 2-hour webinar thing was for nothing, right? Because if you don't do anything, nothing happens, nothing changes. So don't be somebody who has like just so much information, but has no use for that information. If I could I have you guys turn your cameras on? I'd like to take a picture of the group if you guys don't mind. So please, everybody, take yourselves, let's see, turn your cameras on if you're still on here. I'm trying to gonna take a picture. So yeah, just turn it on for a second. I don't have to. You don't have to keep it on forever and ever. But let's see. I keep forgetting how to do it, but there's a way that I can get people who don't have their cameras on to go away. But again, if you guys can hear me, please turn your cameras on.
I just took a shot too.
All right, turn. Everybody got cameras on? Cameras on.
And Hone, while you're doing that, I just wanted to say a big thank you to not only you but also MC. MC was the first podcast I listened to when I started my financial investing journey like 4 years ago. So I want to thank MC for all your time today. It was very valuable, from the Panama coffee farms to the infinite banking concept to all that stuff, the real estate investing. I want to thank you. And Hone, thank you, buddy, for always putting on some great products and great webinars.
Yeah, yeah.
Awesome. Thank you. Appreciate that. Appreciate you.
All right, y'all, look right into your camera. Okay, so what I want you guys to do is look into your camera and smile. That's it. That's all I need you to do. All right, so turn your cameras on and smile. All right, I guess that's all you guys got. All right, cheese. All right, hold on. Let's do it again. Ready, cheese. Come on, D, get in the picture. She ordered Dunkin' Donuts.
Sorry.
It's all good. It's all good. All right, let's do it again. Yep, have your mask off. Hold on. All right, so 3. Okay, look right into the camera, everybody. 3, 2, 1, cheese. Let's do one more. Let's do one more, just in case you guys blinked or looked sideways or something. Andrew, look up, please. Okay, 3, 2, and 1. Got it. All right, awesome. Okay, last question was, can you give the name of the author again of the book? So here it is, Nelson Nash. Nelson Nash wrote the book on how to use your life insurance policy as your own bank. It's a cool thing. Again, rich people do things just slightly different than everybody else. And that's all the difference in the world, really, if you think about it. Just slight difference. That's all. So now, bada bing. Oh, and MC's podcast is called The Cash Flow Ninja. Oh, he commented. Yes, Cash Flow Ninja. So if you guys want to check that out, it's awesome. It's awesome. So.
And the other thing that I would also say, like, that book is great, Becoming Your Own Banker by Nelson Nash. And there's also another book called The Case for IBC. And what that is they did these infinite banking courses when Nelson was still alive. They did these courses like once a quarter across the country. And in that book, they actually took what they taught in the day boot camp and they condensed it and put it all into a book. So that's also a pretty cool resource for something like this that takes you through the process. But that was the book that that really changed the way that I looked at a lot of stuff.
So great power, great responsibility. Step 1, get great power. And then you have something to be responsible for.
Yep.
All right. Well,
Absolutely.
I think that's it. Man, this went longer than I thought. I think this went better than I thought. And it was good. So thank you all for being on here. And MC, thank you for all your time.
Thank you.
Thank you, guys. This was great. Appreciate you all.
All right,
Thank you. Thanks, Home. Thanks, MC.
Thank you, Owen. See you later.
Peace.
Thanks, fellas.
Thank you.